this chapter, we talk about fraud and the principles of internal control. We will specifically look at cash since that's most likely where your fraud is going to occur. This chapter has a lot of definitions and terms that you must know, so make sure you go through your book, write down the definition of these terms. Again, write down these definitions in your own words so that they make sense to you. Also, I want to make sure you understand the difference, first of all, for SOX. This is the Sarbanes-Oxley Act, so make sure that's what you're looking for when you're defining that. And then I want you to make sure you realize there's a difference between internal control components and internal control principles. When we talk about the components, these are things you're going to look for. There's 5 of them. This is like your risk assessment, or maybe monitoring, or information and communication. So make sure you find those 5, write them down, understand what they mean, and know the difference between the components of internal control and the principles of internal control. The principles of internal control are establishment of responsibilities. So again, in your own words, define what that means. We have segregation of duties, documentation procedures, we have physical controls, independent internal verification, and finally, human resource controls. So again, make sure you define these in your own terms, your own words, so you understand what they mean. But let me kind of walk through these and give you some examples, because a lot of these could seem to fit within each other. So we really need to understand what the differences in each of these principles are. So establishment of responsibilities means you know what you have to do or what you're responsible for. So if you know at work, you're supposed to be the one who is ringing up everyone and someone else is supposed to be handling the customer service. It's knowing what you are responsible for in your job. When you think of segregation of duties, this is specifically relating to cash. So if you touch the cash, you're able to touch it, then someone else should be recording the cash. For example, if you know accounts payable clerk, one person is opening the mail, another person is recording any checks that come in. So when you're thinking of segregation of duties, because I know it can get confusing with establishment of responsibilities, remember, always go back to that cash term, because that's what we really want to make sure we separate. Documentation procedures, I want you to think like procedural manuals, so that everything's written down that should be, and everyone knows what they have to do. Physical controls are things like locks or vaults that keep people safe, or passwords even in the age of technology. Things that will physically keep your assets safe. When we look at independent internal verification, that's specifically thinking about maybe a supervisor reviews what you're doing. Somebody internally is double checking your work. And when we talk about human resource controls, one common aspect of that is making people take a forced vacation. It's harder to hide fraud if you're not there. So again, go through this, maybe come up with another example of your own and determine what some limitations of internal control are. We're all human, we all make mistakes, it could be error, things like that. Again, when we talk about internal controls, cash is likely to come up because that's what most people want. So we really need to make sure we can protect our cash. We use this using a voucher system, so make sure you go and look that up. It's just a way of recording everything. And then we have to look at what we call our petty cash. Petty cash is a little bit of cash you have on hand for incidentals. Because let's say a delivery guy is dropping something off, you don't want to have to go through this whole voucher system to get a $20 approval to pay for shipping charges. So companies will have this petty cash on hand for these incidental business charges. When we want to establish a petty cash fund, we're going to debit our petty cash and credit our cash. What this is basically doing is taking the cash out of the cash account and putting it in a separate account for these incidentals, this petty cash account. Think of it as putting this $200 in a drawer, and then every time something comes up, they'll just put the receipt in the drawer, and then they'll take out the cash related to the receipt. So at the end of the month, when we want to reimburse the petty cash, again, when we reimburse the petty cash, the first thing you want to do is determine how much cash do I have to replace. So to replace the cash, I'm going to look at what I started with and subtract how much I currently have. This tells me that current fund contains $15 cash. So at the end of the month, I have $15 left. That means I need to replace $185. To replace it, I'm going to credit my cash account for $185. That basically puts that money right back in that drawer so we can use it again. And we're now back up to $200. The other part when we reimburse is to get all of these expenses that we didn't record on our books. So each of these expenses have to be recorded. We had supplies of $23. We said some postage we paid. That'd be a postage expense, $52. Some telephone charges, that would be utilities. Some other miscellaneous expenses happened that were $100. And the next thing we're going to do, step 2, is to add our expenses. Now you can see this comes to $186. Remember, debits have to equal credits. It's $1. It's not worth investigating. So any of those minimal amounts, we're just going to kind of plug in there. I needed a credit of $1, so I'm going to credit an account called Cash Over and Short. Again, you'd probably have to pay somebody $20 an hour to find out where that $1 went. Not worth it. We're just going to put it in that Cash Over and Short account to make sure our debits equal our credits. The next part of cash is our bank reconciliations. There are just 7 different things that happen with our bank reconciliations. Now I know that in today's world, and when you're thinking about your own checking account, you can just look online and see everything that happened on a daily basis. But if you're looking at a corporate account or a business account, you're going to have hundreds of transactions each month. Because of this, at the end of the month, we do take our bank balance and compare it to what our cash balance says. And there will be some differences. Make sure you understand what these terms mean. Deposit in transit. That means that, maybe I put a deposit in the bank or I put it in an overnight bin. It's not been added to our bank balance yet. So what I need to do is add that to the bank balance. And what you can think of is, who knows about this? If it's a deposit that the company made, the company knows about it. They added it to their cash account. The bank doesn't know about it yet. That's where the adjustment needs to happen. Same thing with outstanding checks. An outstanding check is a check that I wrote, but it hasn't been presented to the bank yet. So the bank doesn't know about it. I'm going to have to subtract that from the bank balance. A bank service fee, banks always charge us fees. They can do that. But we don't always know about them until the end of the month. So we'll subtract that from our book balance. A non-sufficient funds, that's what the NSF is, non-sufficient funds check, is a check that we deposited and then the bank went to go collect on that, but there was no money there. So we need to subtract that back out of our book balance. Sometimes the bank will give us interest. They don't tell us. We're going to add that to the books. And a collection of electronic funds transfer. Sometimes the bank will collect a note on our behalf. We're going to add that to the books. And an error, that all depends, right? We have to see where the error was made and fix it. So let's go through a short example of this bank reconciliation and how it's done. Typically, they're going to give you a paragraph of information. They're also going to tell you the bank statement amount and what the cash amount says. And our goal is to make those two be the same amount. So I'm going to look at the book balance and compare it to the bank balance. We're going to start with our beginning balance of each. Beginning balance on the bank was $14,275. Then we'll read through these. They said there's some outstanding checks as of June 30th. Again, that's a bank difference. We have outstanding checks. These checks are going to need to be paid out of our bank. We already recorded them on our books, so we will subtract that $2,500. The next one says the bank statement has a $125 charge for services. We need to adjust the book side for $125. Number 3 says there was a check that was listed with our canceled checks, which means it was cleared and correctly taken out of the bank for $645. We recorded it mistakenly, so the book is wrong, in the amount of $654. So if you look at your cash account, we have a credit in here of $654. That credit should have been $645, which is a $9 difference. To make this 9 that actually be 9 or 640 5, we need a debit of $9 to get us to that correct amount. So we need to add that $9 on the bank side. That gives me a total of $15,025. And the last one says there was a deposit in transit. That was $3,250. We're going to add that to the bank side, which again gives us that magic total. We make sure these agree, but we're not done. We're done reconciling the accounts, but anything on the book side requires journal entries because we need to adjust our book balance. That first one is a service fee, so we'll add that service fee in, a debit for that expense, and a credit to cash. The second piece was that error, so we have to look at what happens. We know we need to add that $9 back. So cash needs to increase by $9. But the problem is, what is the other piece? What's the other account? It says here that there was a debit to utilities expense when originally this happened. So that's where the mistake was. We want to credit that utilities expense so it has the right amount. So I want you to notice a couple things here. That anything on the book side requires a journal entry. Cash is always included. If we are going to subtract, that cash is going to be a credit. So any subtraction of cash is a credit. We're decreasing our cash. Any addition of cash is going to be a debit. But cash is always included. So if it's an addition, it's going to be a debit. Cash will always be included in the journal entries for the bank reconciliation and only on the book side. The last little piece of this chapter is just understanding these two terms, cash equivalents and restricted cash. So make sure you understand those. You'll get a lot of practice with this in some of the homework, especially the bank reconciliations. And if you have questions, you just let me know.